Welcome to the Three Edge Week in Review for the week of August 15th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here today once again is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, Steve and I will be discussing the recent rally in the equity markets, which began in mid-June, and whether we are experiencing a bear market rally, a market melt-up, or perhaps a new bull market run. Of course, the truth is that we don't know the answer to this question yet, but Steve and I will compare the current rally with bear market rallies that we have seen in the past to see if there's anything that we may be able to learn from market history. In the markets this week, the rally in equities, which began in mid-June, continued into the beginning of the week and then seemed to sputter a bit as we got later into the week. It does seem as though it continues to be the Fed's world, and we as investors are just living in it. This week, the Fed released the minutes from the July FOMC meeting, and it was interesting to see how the discussion during the meeting was, as we might expect, focused on the Fed having to balance the risk of tightening monetary policy too much, pushing the economy into recession, while at the same time having to address the significant risk of inflation becoming entrenched in the economy. This is going to be a difficult balancing act for the Fed. The next meeting of the FOMC will be in September, and there's a great deal of debate about whether the Fed will increase short-term interest rates by 50 or 75 basis points, or maybe more or maybe less. But notably, between now and then, there'll be additional economic reports, including another employment report and an additional CPI report on the rate of inflation. And next week is when the Federal Reserve of Kansas City holds its annual Jackson Hole Conference, and Fed Chair Powell will speak at the conference, and his speech will be no doubt parsed for clues as the future direction of monetary policy. So, Steve, let's get started with our discussion. And I believe what you're going to do is take us through a little bit of market history and bear markets and bear market rallies from the past. And one thing I think is going to be important is I know that you are going to refer to the 200-day moving average. So just important to define that as you go, which I know you would have done anyway. But anyway, so why don't you take us back in a little bit of market history and maybe go through some charts and see what we can learn.
All right. So to start, we have been in a bear market during 2022. Bear market means a down market that went down more than 20%, and that has happened. However, markets really don't move in a straight line. They move in cycles, and even markets that go down substantially or up substantially have counter trend rallies or corrections. And so we've been in a bear market, and we know from history that bear markets often have or interrupted by very sharp rallies that sometimes are so sharp and so prominent that investors have a sense of hope that the bear market is over. They throw more money in. It continues, just like we've seen over the last few weeks, only to falter. So one guide during bear markets is to compare where the market price is with what's called the 200-day moving average. Now, when we model the markets at Three Edge, we look at longer-term valuation factors. We do a very comprehensive analysis of the economic factors in more intermediate term, and then we do a deep dive on market psychology, investor behavior, and how it influences the short term. And within that, there is one of many elements that we look at is so-called the 200-day moving average. That's simply the average price of the stock market you're analyzing over the last 200 trading days, which is roughly equivalent to the last 10 calendar months. And what we've known is in a bear market, the market will fall below the 200-day moving average, and then the bear market rallies will take that market back up to the 200-day moving average, falter, only to fall again. And so that's been a reliable guide in past bear markets as to how far the rallies might go before they falter. Now, of course, eventually they break through, and that's your new bull market. But typically that doesn't happen right away. So I did want to at least start with that.
Yeah, no, that's very helpful. Great. So let's dig in now. Let's look at some of the bear markets that we've seen in the past and the bear market rallies that take place within those bear markets. Let's take a look at some of these charts that I know you have.
So to paraphrase Mark Twain, he once said famously that history does not exactly repeat itself, but it rhymes. And we notice some very discernible patterns when looking at past bear markets. And then later we can look at the current situation to compare and contrast. So let's begin with one of the most classic bear markets, which occurred during the Great Depression. And this bear market started in 1929, ended in 1932. And it fit the pattern that I described. If you look at this chart, you'll see that once the 200-day moving average, which is the smoother line you see, stops going up and begins its decline, from that point on, bear market rallies never carried the market beyond that 200-day moving average. It acted as a ceiling or a cap all the way to the end. And this bear market, from peak to trough, was the stock market was down more than 80%, which is quite incredible. But within that, there were some vicious rallies, which fooled many, many people, thinking that the new bull market was here. It couldn't possibly be a bear market rally, a bear market anymore. And so that's what's happened. Now let's move to the next bear market we'd like to show. And that is the famous bursting of the tech stock bubble that occurred from the year 2000 to 2002. And to look at tech stocks, we look at an index called the NASDAQ 100, which is an index of technology stocks. This index fell over 80% in that short time frame. This is a terrible bear market. And again, you see the same pattern. Once that 200-day moving average started to decline, from that point on, the bear market stayed below or at that 200-day moving average until the bear market was over. And this was over a pronounced period. And again, there were many vicious rallies, some as high as 52% before it continued to go down again. And then more recently, let's look at the bear market that we associate with the Great Recession or the financial crisis of 2008. This bear market started in 2007, ended in 2009. And again, once that 200-day moving average began to decline, we did have cycles, we did have bear market rallies, but never exceeded that 200-day moving average until the bull market was in gear. And I just want to point out, I remember very well, April and May of 2008, we had a strong bear market rally. So many people were fooled. So many people, the media were saying, bear market is over, time to get back in. A lot of cash came back in the market. And this was all before the worst part of the bear market.
Excellent. Okay, so now we've looked at some of the bear markets and bear market rallies of the past. Why don't we take a look at where we are thus far in 2022, which, as you said, it is a bear market because it's declined by over 20%. Now we're in the midst of a rally. What might we be able to think about in terms of where we might go in the remainder of 2022?
So once again, once the 200-day moving average began its downturn, the S&P 500 index, the stock market, has stayed below that 200-day moving average, like past bear markets. Now, over the last few weeks, as you mentioned, Fritz, we've had a vicious rally. And we can call it a bear market rally because we've been in a bear market. We're still below the 200-day moving average. But we're at a critical juncture where we've climbed all the way up just below that 200-day moving average. So if we are in a more extended bear market, then we should expect this bear market rally to start to peter out quite soon, and the next down leg to begin in the not too distant future. And so that's what this is showing. On the other hand, markets are very nonlinear, meaning that at critical times, a small change in the environment or a small change in input could have a major change in output. So if while we're at this critical juncture, there should be some very surprising development in the global markets or in the world or with the Fed, and it were to push us over that 200-day moving average, then the machine algorithms would kick in, the short-term investors that base their discipline more on psychology and price patterns cetera, could come in and give this an extended leg up. And so that's something that we can be aware of. And I will say that based on all our research, there's nothing about valuation that would have suggested the rally we've had over the last few weeks. There's nothing about the economic factors that we look at that would have suggested this rally. In our view, it's strictly based on crowd psychology, buying the dip, trend following, and the machines that also follow trends.
Absolutely. I mean, in some respects, you sort of have to ignore a lot of things in order to carry forward with this rally that we've experienced. So always, my final question is, based on what we've discussed today, how should investors consider positioning their investments for the way forward here for the rest of 2022 and beyond?
Given that the markets are still overvalued by our measure, given that most of the economic factors are still negative by our measure, and given that we're still below the 200-day moving average, we think it's premature to throw caution to the wind. We think one should still stay defensive. However, we are at a critical juncture. We know in the markets, they're not 100% predictable. Things can happen out of the blue to turn small changes into big outcome differences. So we have to be cognizant that if we do break through this 200-day moving average, it could extend this rally further. And perhaps it's prudent to look at ways to have some modest participation beyond this currently defensive level in vehicles that are relatively undervalued. But our base case is that we're still in a bear market. This is a very typical bear market rally, and that we would expect, barring some unforeseen circumstance, for things to begin to decline.
Excellent. Great. Thank you very much for your insight into all of this. So that will do it for Steve and me. Remember, all our videos are available on our 3Edge YouTube channel, and please feel free to subscribe to our 3Edge YouTube channel. In addition, our videos and all of our written commentary are always available on our website, and that's at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.